Unrivaled Nation, at the end of the last year, I called out how Fannie Mae might be the best performing stock for 2025. And then a few weeks later, after I did that video, I also called out to my subscribers at Unrivaled Investing that I had bought Fannie Mae shares for myself, around $6 per share. Since that original video at the end of December 2024, the price of Fannie Mae is up around 170% plus, and that's Fnma. This was based on Bill Ackman's presentation talking about Fannie Mae and Freddie Mac, thinking that there was a lot of asymmetry, a lot of significant upside, and it really, a key part of it was based on what President Trump had said himself, suggesting that, look, these common stocks, they generate huge profits and they should be privatized. They shouldn't be owned by the government. They shouldn't be perpetually under some sort of conservatorship. And, so this was based on literally his own writing. And so then just last night, President Trump tweeted on Truth Social saying, "I'm giving very serious consideration to bringing Fannie Mae and Freddie Mac public. I'll be speaking with Treasury Secretary Scott Bessent." And he's talking about how, look, these companies are doing quite well. They're throwing off lots of cash, and the time would seem to be right. Stay tuned. So this obviously is getting investors excited, causing Fannie Mae, Freddie Mac stocks to jump today. So in this video, I'm going to walk you through the sort of reflection on where is Fannie Mae. That's the one I'm going to focus on because that's the one I personally bought for myself. Where do I see it potentially going in the years ahead? How do I think about sort of the risk reward from here? And also, we'll do an overview of the business so that way you can understand it as well, because it is an exciting time when you see a stock up 40% off of a president's tweet, but there still is that potential for hundreds of percent upside. And that's why I personally still own a stake in Fannie Mae. So we'll talk about that throughout this video. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment content, I do appreciate you hitting that thumbs up, hit that subscribe button. So let's dive right into understanding what's going on with Fannie Mae. So first of all, this is a very interesting business, and we'll talk about the dynamics of this business in just a second, but just the magnitude of it. They have $4.1 trillion of effectively a business that they're guaranteeing. These are mostly tied to single-family mortgage debt. They own or guarantee roughly 25% of the single family mortgage debt outstanding, around 21% of, let's say, apartments, multifamily mortgage debt in the United States. So this is just an absolute behemoth, $4.1 trillion when you're thinking about their book of business. And the business itself is a little bit complicated. This is sort of the 30-second, download on sort of how they operate. You have home buyers, they need a mortgage to buy a house, they pay their monthly payments that include the principal and interest. The lenders, they're the ones that underwrite the mortgage for the home buyer, and they then sell those mortgages to someone like Fannie Mae, who, as I already mentioned, cover about 25% of single family mortgages. So they're selling what this loan that they originated to Fannie Mae. Fannie Mae's giving them the cash, so then they can use those proceeds to issue more mortgages for home buyers. Fannie Mae takes the mortgage, which they bought from the lender, the originator. They set loan standards saying, look, whatever type of loans that that we might buy, it has to have these sort of framework in terms of quality. And they then, sort of dice it up. They pool these different loans together into a mortgage-backed security, and they guarantee these mortgage-backed securities. And they ultimately sell these securities, which include many of the different mortgages that they've acquired from various different lenders. It's all in sort of one basket, this mortgage-backed security. It's sold to investors around the world, pension funds, investment funds, all sorts. And the appeal here is that then you're tapping into a global investor market that ultimately makes it easier for that home buyer to invest, because the lender, they didn't have to have that capital easily accessible. It's capital that they lent it, but then they got it back because Fannie Mae then bought it. So it's ultimately these investors buying mortgage-backed securities, and these mortgage-backed securities are guaranteed by Fannie Mae, and Fannie Mae in turn collects a fee on the mortgage-backed securities that they sell to investors. And the way to think about this fee is it's ballpark, depends on the product, but at the end of the day, it's around, 0.6% or 0.5%. And the reason why that's important is when you're talking about a huge book of business. We were talking about that $4 trillion figure just a second ago. When you're talking about, 0.5% or a little more than 0.5%, it adds up. And so you can see in 2024, their net interest income, their net revenues were around $30 billion. Most of that did come from these guarantee fees that they have, that they, layer onto the mortgage-backed securities. And this is just an incredibly profitable business. The last 2 years, you can see around $17 billion in income against around $30 billion in revenue. So around a 50% plus margin, net profit margin. So these are exceptional businesses. These are effectively insurance businesses on the mortgage-backed security market, which they create and which ultimately ties back to the homeowners. You can also see in the first quarter, yet again, another very profitable quarter. And once again, you can see the quality here. Our single-family conventional guarantee book is about $3.6 trillion in size. 76% of the underlying mortgages are below a 5% interest rate. That means, look, if you're below a 5% interest rate in this environment, a lot of these folks, they're going to say, hey, I'm going to do whatever it takes to keep paying it because that 5% is so good. You don't want to get locked in at 7-8%. So, it's a quality loan book. And they also talk about how the, weighted average mark to market on the loan to value ratio of 50%, a weighted average FICO credit score of 753. So, you're looking at broadly very solid metrics. This is a quality business, providing effectively an investment vehicle for investors around the world that ultimately, subsidize the home buyers in the United States, and delinquency rate on this single family guarantee book of around 0.5%. So it's a fantastic business generating billions of dollars. So the question is, how much capital are they going to need going forward? What's going to be the new share count? Because there's a lot of sort of moving pieces to think about, as you're looking at Fannie Mae. When you're looking at where they are now, they do talk about, this was from their first quarter presentation, they talk about how, based on the capital requirements, which compares them to the systemically important banks, they're saying, yeah, our capital ratio relative to our risk assets is around 10.5% versus the systemic banks around 11%. One might argue that is overly punitive to say, yeah, you need to have the same sort of, capital ratio based on risk adjusted assets versus these banks, when many of these banks have, derivative books that are extremely difficult to calculate, say whether or not you're actually making up the numbers. Fannie Mae has a much cleaner business than where they were when they were helping package, subprime loans. This is a much better business now. We just talked about the quality. We talked about the delinquency rate. We talked about the FICO scores. And so, it doesn't make sense even for them to, have this sort of, very tough hurdle, ultimately requiring around $140 billion in capital to say, yeah, this is how much capital this business needs. And relative to the equity, which is approaching around $100 billion, that's, through the net income that's accumulated on their balance sheet over the last few years, they're effectively saying, yeah, based on the minimum capital requirements, the deficit, so the hole that they would need effectively to be public is somewhere between $30 and $40 billion. They've been closing that hole as they've generated lots of earnings, but still there is this, deficit based on the capital requirements that they have. If you were to say once again that, maybe these capital requirements are too onerous, maybe that 30-40 shrinks closer to zero, but depends on the investor. Bill Ackman, who owns a stake in Fannie Mae, I think he makes the case that, yeah, that's too onerous, the various different regulatory hurdles. But, at the end of the day, it's going to depend on the current administration. So one view is that they will issue new shares. Let's say the current share price is around $10. Maybe it, in the weeks, months ahead, it bounces around. If they need to fill a $33 billion hole at, somewhere between $10, maybe $15 a share, you're talking ballpark around 3 billion new shares that might need to be issued. But before any new shares can even be considered, you do need to factor in what happened during the Great Financial Crisis, of which the Treasury provided capital up to around $120 billion via senior preferred stock. That senior preferred stock is still outstanding. And by the way, based on the terms, it suggested that the preferred stock has a liquidation preference, so it needs to get repaid to the tune of $216 billion. That's a lot of money that would need to get repaid. That also has another element. This is what creates there's inherently a lot of volatility and complexity with this business. No doubt. There's a lot of risks still involved. So just because there's a tweet, still a lot of uncertainty. Don't walk away from this saying, oh, the stock price is up today, therefore it's certain to, go up to $30 per share, let's say in the months ahead. There will be uncertainty. I personally own a stake because I think there is still strong optionality. There is that strong potential. But let's keep going through some of these barriers that make it complex. So you have the Treasury's investment, of their senior preferred. And then you also have the fact that the Treasury investment included warrants that said, yeah, at some point, maybe you do go public, we're gonna want 80% of the common stock because of this investment we made during the financial crisis in 2008. Originally, Fannie Mae had around 1 billion shares outstanding, and so this warrant would bump it up to closer to 6 billion shares outstanding. So that gives you an understanding of sort of the dynamics here with Fannie Mae. Sorry, that's my little dog in the background. So the question is, what is Fannie Mae stock worth, given these dynamics, Fnma? And first of all, in full disclosure, none of this is financial advice. And also, just last week, Doug S., he was a member of the Unrivaled Investing community, he said, I've been a member only 3 months and I'm overwhelmed by how good your service is. Your average costs on some of your top holdings are several times lower than the current price. This follows Sam, a premium subscriber, who said, Daniel, just re-upped my annual subscription after 1 year of being in the community. This subscription has paid for itself many times over. If you're looking for compelling ideas, come check out unrivaledinvesting.com. I will be raising the rate at the end of this month. So now is the time to lock in the favorable pricing. So looking at, what's going on, thinking about Fannie Mae relative to my personal investment journey, it doesn't really check, the checklist that I have, as I think about the business in terms of obvious growth or, no blow up risks. This is much more of a special situation type of, dynamic where it's based on the asymmetry and unique qualities of Fannie Mae. So it's not going to be, like an all-in bet for my own personal portfolio. My portfolio typically follows, very repeatable process. I'm focusing on this checklist, the aligned management, compelling valuation, obvious growth. That checklist goes whether or not you're a micro cap or a $1 trillion company. And that is how I get comfortable making bigger positions. I do still set aside a percentage of my portfolio or a few percent of my portfolio thinking about special situations. And so Fannie Mae goes into that special situation, basket, thinking about, what's unique or something that has a lot of upside potential. So looking at Fannie Mae, you could see that they've generated, tens of billions of dollars in profit each year, fairly consistently, most recently around $17 billion in earnings. And they also call out that, look, they drew around $120 billion from the Treasury, but they've received back, the Treasury has received back $181 billion. So $62 billion excess has been paid. So you could make the case that the Treasury's $120 billion, investment, that might be, maybe they effectively say, hey, that we're good. We've already been repaid. So a lot of this is that dynamic of, how will the government treat the senior preferred? What's sort of the, path ahead? Here it is. Here's my framework for thinking about just the profitability and a multiple. Let's start high level thinking about this. So right now it's around $17 billion in earnings. Let's say it goes anywhere from 14 to 18 billion in the years ahead. And given the quality of the business, when you're not underwriting subprime, ninja loans, no income, no job or assets, what's a fair multiple for a very quality business that arguably could repay a lot of their profits as dividends to shareholders? Personally, I think a teens type of multiple, maybe even low 20s, could be possible. That would get Fannie Mae to around $200 to $400 billion in value. That is the inherent value of a business generating this type of profitability. But then the question goes back to, well, what's the share count? You have to once again, we had that Treasury warrants, we had the shares that were previously outstanding, and then you have some sort of incremental share issuance, because they're going to want to plug maybe some deficit that it's in flux based on how you even calculate it. So maybe an incremental 2 billion in shares, maybe an incremental 4 billion in shares. So somewhere between, let's say, 8 billion pro forma shares or 10 billion in shares. And that would get you to roughly $20, let's say ballpark, to around $50 per share versus Fannie Mae's current share price of around $10. So that does get you this framework of, let's say 100% upside potential to maybe 400% upside, depending on, how these different, aspects come about and, how much shares do they have to issue? What's the market sentiment? What's their actual earnings power in the years ahead? And it is important to remember, this is hypothetical. Stock price can go way higher, way lower. A lot depends on their execution. But in this case, a lot depends on the political developments that are difficult to anticipate. If President Trump or Treasury Secretary Scott Bessent fail to enact, this in a reasonable manner in terms of bringing it public, or there are external events preventing Fannie Mae from exiting conservatorship, it could easily go back to sub $1 per share. So there is that risk of going from 10 to 1. So I'm not trying to say rah, this is going straight to 50. There are dynamics here that if you're going to say it's going to go straight to 50, you need to be able to comfortably say exactly, how much shares they're going to have to issue to fill any sort of deficit, what's going to happen to the senior preferred, and what do you think their free cash flow and profitability do you think will be in the years ahead? So you have to be very comfortable and say, yeah, I have a high degree of certainty, and that's why you could say. But I still think of this as a favorable, asymmetrical to the investors in Fannie Mae, and that's why I own a stake. But let me give you an example of why this is trickier than you might perceive, even after what I've shared. One example, and this is why some investors, I think PIMCO is a major bond investor, they've talked about, maybe it should just stay in the conservatorship, because the risk that all of a sudden the mortgage-backed securities that Fannie Mae, packages and sells, the risk that as a standalone vehicle without necessarily that government guarantee could cause the interest rate that investors want, global investors want, to spike higher. In which case, because those investors ultimately, those global investors ultimately flow through to the home buyers, you could have a situation where if investors are worried about the structure in Fannie Mae, that the cost of buying a home could go higher because of effectively global investors saying, I don't necessarily trust this mortgage-backed security, this guarantee from Fannie Mae. I'm going to want a little bit more of a premium because it's no longer under the wing of the government. So that is definitely some sort of dance that Treasury Secretary Scott Bessent is going to need to think about, saying, okay, how do we make sure that investors around the world still believe that there's this government guarantee without necessarily having to give it? Or maybe it's we own 80% of the company and we will get another 15% of the company if you were to need to tap into some sort of facility that we offer, and we're going to keep this facility on hold. So there's that uncertainty. Is it possible that the Treasury, the senior preferred, gets rolled over into another bond or a type of bond that costs interest that could actually hurt their earnings power in the years ahead? So you have these dynamics. And then I'd say lastly, and this is probably the ultimate wild card that affects all assets, not just Fannie Mae, is the uncertainty around the U.S. fiscal situation. And you just saw yesterday a 20-year bond issuance that went awry, and it caused the 20-year yield for the U.S. Treasury. I'm not talking about Fannie Mae. I'm talking about the U.S. Treasury of the United States Treasury. When they're issuing debt, it was a 20-year term or 20-year paper. And it caused, investors effectively said, I'm not so crazy about it. And the amount of investors interested in buying was actually lower than in the past. And so this caused the yield on that 20-year paper to jump a bit higher. It wasn't even a huge offering. It was, a couple, like a few tens of billions of dollars, but not once again, a rounding error relative to the trillions in dollars that needs to get refinanced this year. So that is the concern that investors need to think about, which is that if you have some sort of deficit spiral where investors start saying, I need more juice, I need a higher yield to justify a country that is not really respecting its financial power, and it's just having these unlimited deficits that are still super high, that could become the priority that the president and Treasury Secretary Scott Bessent have to focus on. And in that situation where, let's say, the 10-year Treasury yield goes from 4.6% to 5%, that could, and I strongly suspect, cause a reset in global assets. It could certainly cause valuations for U.S. stocks to come significantly underwater or to come under pressure. And so that is the question of, is that going to be a problem that sort of derails the process that President Trump is encouraging for Fannie Mae? He was talking about now it's a good time. Yeah, it's a good time now. If the 10-year goes, let's say, to 5%, it's not going to be a good time to focus on Fannie Mae, which is already a complex situation. It'll be a time to focus on, hey, how do we get the 10-year back to around 4% as we refinance our debt? So there's so many different elements that need to go into this. And then you have the political elements, which is, you could have, who knows what the political parties, dynamics look like in 2-4 years from now, in which case, if you don't get the momentum now to drive change with Fannie Mae, then there's a real risk that in a few years from now, it's just investors and the existing politicians say, you know what, too hard. Let's just focus on some other pressing issues. And it just stays under the government's wing and goes back to sub $1 per share. So there is all that dynamics that investors need to consider. For me personally, I bought it, back when it was single digits, when I was thinking, hey, this could be $30, $40, $50, maybe even $60 share price, depending on the circumstances, thinking about this business. And I like that asymmetry, and I still like it. I still own a position. I haven't sold any of my Fannie Mae shares. But this is just sort of the framework. I hope this video, sort of walking you through the uncertainty, the complexity with the situation, along with why it's up today. I hope it's been helpful for you. Thanks so much for tuning into Unrivaled Investing.